Everyone, we are the presenter of Chapter 14, Expanding the Boundaries of Banking. I am Julian Francina Aaron Serdan, the first to report. The introduction for this is the activities of banks have changed dramatically during the past 5 decades. Between 1960 and 2018, banks increased the amount of funds they raised from time deposits and negotiable certificates of deposits, increased their borrowings from repurchase agreements, reduce the reliance on commercial and industrial loans on consumer loans, increase the reliance on real estate loans, and expanded traditional lending activities where their revenue is generated from fees rather than the interest. Off-balance sheet activities. Traditional banking activity, such as taking in deposit and making loans, affects a bank's balance sheet because deposits appear on the balance sheet as liabilities and loans appear as assets. For instance, when a bank buys and sells foreign exchange for customers, the bank charges the customers a fee for the service, but the foreign exchange do not appear on the bank's balance sheet. Loan commitments. A bank earns a fee for a loan commitment. A bank agrees to provide a borrower with a stated amount of funds during a specified period of time. The fee is split into two positions. One, the upfront fee when the commitment is written, and non-usage fee on unused portion of the loan. Interest is charged for loans are actually made. It is usually marked up over a benchmark lending rate. 2. Standby letters of credit. This is also availed of in connection with importation of goods by the businessman. 3. Loan sales. Loan sales, also called the secondary loan participations, involve sales of loan contract without recourse, which means that the bank does not provide any guarantee on the value of the loan sold and no insurance. Instead, the bank holding the loans in their own portfolio, it converts bundles of loans into securities that are sold directly to investors through financial markets. 4. Trading activities. Trade, bank trading in these markets are primarily related to hedging in banks' own loan and securities portfolios or to hedging services provided for bank customers. As the beginning of financial crisis of 2007 to 2009, most people were unfamiliar with such terms as mortgage-backed securities, MBBS, collateralized obligations, CDOs, and credit default swaps, CDDs. During the financial crisis, these terms became familiar as economists, policymakers, and the general public came to realize that commercial banks no longer played the dominant role in routing funds from several to borrowers. Instead, a variety of non-bank financial institutions, including investment banks, mutual funds, and hedge funds, were acquiring funds that had previously been deposited in banks. These non-bank financial institutions have been labeled the shadow banking system because, while they match savers and borrowers, they do the outside commercial banking system. Investment banks. The smooth functioning of security markets, in which bonds, stocks, and derivatives are traded, involve several financial institutions, including investment banks, security brokers, and dealers, and venture capital firms. Venture capital firms provide funds to companies not yet ready to sell securities to the public. Role of investment banks. An investment bank is a financial intermediary that performs various services, including complex financial transactions, as raising capital for corporations, governments, or other entities, underwriting securities, facilitating mergers, and other corporate reorganizations. The two distinct roles of investment banks: the corporate advising and the brokerage division. The two supposed to be separated and distinct. So within an investment bank, there is so-called wall between this division to avoid conflict of interest. Investment banks employ professional investment bankers who help corporations, governments, and other groups group plan, and manage large projects, saving their client time and money by identifying risks associated with the project before the client moves forward.
So I am Maria Cherish Di Tabinas. I am the second presenter for Chapter 14. So now let's move on to the typical divisions within investment banks. So these banks includes two groups, the industry coverage groups and the financial product groups. So the industry coverage groups, they develop client relationships with companies within various industries to bring financing, equity issue or merger, and acquisition business to the bank. Second is the financial product groups. So there may be separate product groups that specialize in asset financing, leasing, leverage financing, and public financing. Next is the types of firms engaged in investment banking. First is the bulge bracket banks. So these banks, they provide their clients with full range of investment banking services, including trading all types of trading, asset management services, equity research and issuance, and third is the M&A services. So next is the middle market banks. So these banks provide the same full range of investment banks. So this includes the equity and debt capital market services, financing and asset management services, and M&A and restructuring deals. So third is the boutique banks. So boutique banks includes two banks, the regional boutique banks and the elite boutique banks. So regional boutique banks, they generally handle smaller M&A deals in the range of $50 to $100 million or less. Second is the elite boutique banks. Most elite boutique banks begin as regional boutique banks and then gradually work up to elite status. So now, let's proceed to the areas of business. So it includes two, the brokerage and the corporate advising. So the brokerage includes three, the proprietary trading, the acting as a broker, and research. So proprietary trading, investments banks have their own funds and they can both invest and trade in their own money. And the acting as a broker, banks can match the investors who want to shares with companies wanting to sell them. So it is known as market making. Third is research. So analysis look at economic and market trends, make buy or sell recommendations, issue research notes, and provide advice on investment. So second is the corporate advising. So corporate advising includes also three, the bring companies market. So investments bank, in this investment banks can raise funds of new issues, underwriting initial public offerings or IPOs. Second is bring companies together. So banks facilitate mergers and acquisitions or M&A by advising on the value of companies. Third is the structuring products. So clients who want to sell a financial product to the public may bring in an investment bank to design it and target the retail or commercial banking market. So finally, let's proceed to how investment banks make or lose money. So in making money, they also receive dividends from investments they hold, interest from loans, and charge a margin on financial transactions they facilitate. While in losing money, banks may create financial products which they fail to sell on other investors, leaving them holding loss, making securities or loans. So again, we are reporting the Chapter 14, Expanding the Boundaries of Banking. That's all, and thank you for listening.